You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com and co-hosts Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com.
All right, everybody, welcome back to the Option Block. My name is Mark Longo, coming to you live from the scenic and currently under construction Options Insider Studios. So if you hear some banging or things, we're working, we're expanding, we're making things even better for you guys over here. Of course, it makes it a little fun to do audio. I just had the contractor change up what he was doing. Is going to a handsaw now. So hopefully that'll help with some of the background noise. And if that wasn't enough fun for you today, we are recording this, of course, on Monday, September 21st, those of you playing the home game. And for those of you on the internet today, you also know today is the day of the massive, mega, world-crippling, and indeed Options Insider Radio Network crippling Skype outage. We have managed to do a workaround here in the process, blowing the minds of Uncle Mike and indeed the Rock Lobster with all this newfangled technology we are throwing at them. So we're hoping everything's going to work well. We're kind of running on the backups of backups here, but hopefully everything will work, and hopefully they will be able to make it work on their ends. A lot of big ifs. So probably going to be a little bit of a truncated episode for you today, but we're happy just to get anything in the can for you guys today. And of course, where can you find all the goodness? Maybe this episode not coming out to you in time or something like that, or a little bit too truncated for your taste. You want to check out some of the other goodness we put up. Well, of course, surf on over to the mothership, the flagship, theoptionsinsider.com. That site's still up and running, even if Skype and the rest of the internet doesn't want to play ball. So surf on over there, click on the Insider Radio Network tab. You can stream all of the delicious and tasty options goodness we put up there for you. Thousands of hours worth of content across our many, many programs, over a dozen. So if you got some time on your hands, you want to learn about options, you want to learn about unusual activity, you want to get into some futures options, or learn about what a financial advisor should bring to the table, or whatever interests you from an options perspective, you want a daily news breakdown, you want perhaps a weekly strategy insight, whatever the case may be, we got it all up there for you on the network. So you're commuting, you're training, wherever you're doing, we got you covered. Surf on over there. Of course, find it iTunes, TuneIn, Stitcher, pretty much wherever you find your favorite podcast, including our mobile app, also working today while the rest of the internet is down. So no shortage of ways for you guys to listen to our old stuff, even if it's hard for us to make new stuff. So let's bring on the rest of the crew before the internet decides to boot them again, starting off with the man coming from the land of apparently no technological problems whatsoever. Everything is working hunky-dory out there, also known as St. Charles, Illinois, where we are joined by Uncle Mike Tusaw from RCM Wealth Advisors. Uncle Mike, welcome back to the program now that we finally got everyone on board here.
Oh, always exciting to be here. And for all of our listeners, Mark Longo is officially the tech geek of all time. I don't know what he did, but somehow my phone was ringing and some weird program I'd never heard of before. And then all of a sudden I see myself on my phone. He's like, oh, I see you. So somehow he broke into my phone, and that shows you the dedication of this man and this network for what he will do to make this show happen. If he doesn't get Skype, he will come out and find his hosts to make sure that it'll happen one way or another. By gosh.
I will track you down on whatever device you may have at hand in order to get you on the old program. Yes, we will go through many lakes, including some perhaps less than legal hacking in order to get Uncle Mike and the rest of the team on the old program today. And we also used our hacking skills to bring in the Rock Lobster himself, he from the Luddite Mecca of the world known as the hinterlands of Maine, but we managed to reach out to him too. Our tendrils are long and indeed vast. Mr. Rock Lobster, welcome back to the program, sir.
It is great to be here on the Options Insider Radio Network. Yes, I too am surprised at all the myriad ways there are to connect via the internet and video. It's actually a little spooky.
So you don't like us popping up on all of your random devices at once? That kind of freaks you out?
Like the camera on my laptop freaks me out a little bit, Like who's looking through there? So apparently anybody can look at there when they want to, I guess is the answer.
When you see my eyeball popping up on your laptop screen at night in your bedroom, just don't worry about it. That's just normal. That's normal surveillance.
Yeah.
That's not at all creepy.
Yeah, it's not at all creepy and strange. But apparently it is much easier to do than we all thought if you happen to be Google.
Yes, indeed. When all else fails, turn to the mothership, turn to Google. All right, and before even Google fails us, let's dive right on into the trading block.
The trading block.
All right, everybody, welcome to the trading block. This is indeed the portion of the program where we break down what's moving, what's shaking, what's rocking, what's rolling on the old street. Today was another slight upside day on the broad market, with most of the major indices creeping ever so slightly to the north. S&P up just under 6 handles, the Dow about 100 or so. NASDAQ actually taking it on the chin a bit, down about 7 or so. And, of course, the good old VIX cash continuing its, some might say, inevitable erosion. Some might perhaps not, given all the things we're seeing out there in the marketplace today. Some might say it needs to be at these levels. Continuing its erosion today to the downside, off about 1.3 handles there to just south of the 21 handle. So some action today, but perhaps not as rockin' and rollin' as we have seen of late in the marketplace, but still a lot for us to sink our teeth into. Let's start with you, going in order of distance today, Mr. Rock Lobster. In this day, comparatively quiet day, what caught your eye in today's activity, sir?
I think mostly just two things. Well, one is I think Hillary Clinton, some guy bought an old generic drug and he jacked the price up, went to the New York Times. So of course, it was in the New York Times. It ended up in Hillary Clinton's campaign, and she's going to fight for lower drug costs and stuff like that, albeit that this person raising the cost of the drug to I don't know how much, used to be like $13, then it became $650 a dose. Probably set some teeth grinding, but that took down basically her whatever she proposed to regulate drug prices. Pretty much sent the biotech industry in a swoon. Most of those stocks are down somewhere between 3% and 6% today. So already Hillary has market power, just kind of going in the wrong direction for all that want to be long anyway. And two is I'll just call it the skittishness of volatility products, volatility futures, term structure. Everything about the volatility market right now says, what the heck is going on? It is a flat term structure, slightly backward, without really any events on the horizon, totally and absolutely confusing to what is going on. So I think, Sebastian, he was on CNBC this morning, and he said, hey, you know what? The Fed's not showing any leadership anymore. They're showing waffliness. They just said we're going to raise an eighth, and we're going to raise an eighth later or a quarter, whatever, and just get on with it. And right now they're just, we're going to raise, we're not going to raise. We don't know what we're going to do because the world is such a scary place. I mean, Volcker didn't have that problem. He's like, we're raising. Rates are coming up. That's it. And I think stocks are suffering because of it.
Yeah, we kind of chatted about that on Vol Views on Friday, the wishy-washy nature of this current incarnation of the Fed. There's, of course, minutes coming out today where some of the governors, some of the members of the board there are still insisting that there needs to be some sort of increase in 2015. Their reasoning is somewhat lackluster, I think. They say that the dangers of remaining here are worse than whatever a 25-point basis raise. It kind of seems like they're saying they need to do it just to do it, which is kind of the argument Yellen has always somewhat floated, in spite of any other, global macroeconomic evidence to indicate that we need some sort of applying of the brakes here, even as negligible as 25 basis points. Again, this is not the Fed cast. We won't go too deep into it, but still, you're right. I think lackluster, probably a good term for it. You have the old Greenspan days where he would freely clamp down on the old irrational exuberance, as he called it. And depending on your view of that, you either liked it or you didn't, but still, it was a very different Fed era. Now we have an era where the Fed's tools are somewhat limited. QE is done. Rates are effectively zero and have been for a long time. What's a Fed to do to remain relevant? Well, I guess kind of raise your finger in the air and say, pay attention to us. We may raise, we may not. And in spite of all the Sturm und Drang they have caused as a result of this, all the exacerbating of volatility, kind of a bit of a self-fulfilling prophecy. They raise their hand and say, pay attention to us. We may raise, we may not, but probably may do something by the end of the year. They proceed then to exacerbate all the volatility in the marketplace, which in turn they use as justification for not doing anything. So a self-fulfilling cycle of Fed not inaction, which is, I think, frustrating to a lot of people. That said, before I keep going on about the Fed, Uncle Mike, save us. What caught your eye in today's activity, sir?
Well, I think it's all about the Fed these days. No, just kidding. No, I agree with you with what's going on with the Fed. I'd like to see at least something. They need to take Andrew's advice and just do something, I think. But the thing that I really noticed today, it's kind of been an ongoing theme I talked about on the show a little bit last week in the strategy block, was the fact that if you look at the open of the market today, we're really, based on the open of trading today, at 8:30, SPY opened at 196.44 and it closed today at 196.46. Now, with that, once again, the rally came overnight. And so, yeah, we had some up. We were a little bit higher earlier in the day and we were a little bit lower later in the day and we came back. But one thing that I think is just continuing to be a theme here, at least for the most that I can remember in a long time anyway, is the fact that a lot of our market movement has been coming overnight. This is very much a gapping market. And I think that it makes a very good case for option trading in that instead of putting in a stop loss, you may want to get some type of a hedge in place overnight, depending on your style of trade and depending on how tight you want things to be. But aside from the Fed, like what you guys were mentioning, and everything else that we have going on, which is, well, not a lot when the attention that's being shown to the Fed, I think the main point of interest right now is the fact that a lot of stuff happens when we go to sleep.
Yeah, good argument to be made there for some downside protection in the old portfolio. We hear this a lot from people. Hey, what do I need an option for? What do I need to pay all that money for? I can just work my stops. Of course, we said back in August 24th, nearly a month ago now. Hard to believe that was almost a month ago. But in that mini flash crash sell-off, call it what you will, how well did your stops work? And of course, how well have your stops been working in the resulting vacillations, volatility we've seen in the marketplace of late? Very easy to get yourself whipsawed out of a stop or a position right now at a very, very, shall we say, less than ideal price point. Hence, the owning a little bit of premium to the downside may be a way to mitigate a lot of that. And of course, as we said earlier on the show and other shows, let you sleep at night a little bit, because that also is a nice thing. When even if the market gaps down, doesn't matter. If you have a put, you will be there. You'll be stopped out of that strike. Now, there are some, execution issues there. When we saw on the crazy gap down day, the markets got pretty wide, so you may not get the ideal bid to hit that put on if you want to sell it, but you'll get something close. And particularly if you work it a little bit, you should be able to get out at some sort of decent opportunity, some sort of decent price once things settle down a little bit. But still, it will be there. You will be protected, so you don't have to worry about the issues of a stop loss where you're going to be filled at wherever the market decides to stop. And chances are that probably won't be a very attractive level at all. In terms of looking at downside, I bet you a lot of people out there in Volkswagen today and the last few days wish they did. And some people apparently did, because they're looking pretty good. Our buddies over there at Bloomberg were writing up some options activity they saw in options on actually the preferred listing for Volkswagen, preferred shares. They took a beating. Of course, if you've been following the news for those guys, they playing fast and loose with some of our domestic emission standards here, and that's coming back to bite them now. The stock is off quite a bit. I think the latest number is wiping out. This is, again, all in euros. because it is an overseas corporation, 16 billion euros, about roughly $18 worth of market cap, which ironically, if you look at it broken down, is more than the entire market cap of some of their rivals out there, like Citroën and those other ones out there. So yeah, not exactly a good one. And of course, they highlighted people who have made some money on the downside there in Volkswagen, including 3-month out, some puts that were trading a penny, a cent, just end of last week on Friday, gapping up to a whopping 70 cents, euro cents anyway, today. So not a bad 70x increase out there. Mr. Rock Lobster, I'm thinking you would take a nice 70x return on some of your trades, would you not?
You know what? I might get out at 69 times.
Yeah, why be a pig? Why be a hog, you know?
I guess you couldn't even screw that one up. You just woke up and you're like, oh, wow, I'm rich.
Yeah.
It happens.
That's the nice.
Not often, but it happens.
That's the nice. Talking about the gapping working in your favor. That can happen on the long premium side there when you all of a sudden have these puts just fall into your lap that were worthless, and you're going to close them out on Friday. Maybe you decided, I'm too lazy. I don't feel like getting that 1 euro cent. Not worth the commissions. Bam, 70x today. You're happy camper.
Well, how about the guys with all a bunch of synthetic puts, in there, all the market makers in their positions with all those long calls? Oh, my gosh.
Yeah, lovely.
That would have worked out.
Lovely stuff out there for all of them. But yeah, so interesting stuff, lighting it up today. Not as rockin' and rollin', not as rock'em sock'em robots as we have seen in recent sessions and recent weeks. There's still a few things to sink our teeth into. And we are, like we said, doing a bit of an abbreviated show today. We want to hit on some of the weirder ones that caught our eye today as well. So without further ado, let's dive right on into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, that funky tune means it's time once again for the Odd Block. This is, of course, the portion of the program where we break down what was catching our eye out there from a little bit of the weirder, the wilder, the more bizarre side of the options market. Going to kick things off with a name I don't believe we've touched on this one in the Odd Block in the past, so a bit of a newcomer. This is Ensco PLC, ticker symbol ESV. This one, if you're not familiar with it, get back out to the land of energy, in particular offshore drilling. Closing today right around 15.5, so pretty much unched on the day today from an underlying perspective. This is the name that's doing about 3,500 contracts or so a day, but they were rocking and rolling pretty well from an options volume perspective. Over 7,000 going up, well over 7,000 going up on this name. But what started catching our eye out here was the OC 1318 Strangle going up, starting off 2,800 times on the calls, 1,200 times on the puts for 15 and 20 cents respectively. Looks like paper selling. So coming in, hitting that bid at 35 cents. As the day went on, a total of over 7,000 on each of those strikes. So about 14,000 total. Looks like this guy came in and just hit him everywhere, every bid, every floor, trying to just take out every bid he could find. Again, a pretty aggressive strangle seller. Looking at the chart here for the past 6 months or so, ESV has been on an interesting ride, getting as recently as back in May, trading nearly $28, about 27.5 or so. So this one has seen some darker days of late, not surprisingly, given what we've seen out there in the broad petroleum markets. Our friend out here saying, you know what, that's it's going to continue for a while, but not beyond this 13-18 range. So, bit of an aggressive strangle seller coming in. Mr. Rock Lobster, kick us off here in the Odd Block. What's your take on our friend blasting out both sides here in ESV?
Well, there's a theme to this Odd Block today, and this is part of the theme where, there was, I guess, the energy, the energy agencies and all of that. The oil barons are saying, there's going to be about $1 trillion of reduced exploration, $1 trillion cut. because of
small
oil
change,
prices.
small cuts.
Small cuts. So obviously a company like ESV would get hurt by this. So I think the traders figuring, okay, they've already taken about 70% of the value out of the company, so can't go much lower. And since it's not like anything great's going to happen in the next month, I'm going to sell whatever juice is left. And I mean, they got 35 cents on a $15 stock. It could be, they could own the stock and cover it, and try to generate premium by selling calls and puts, which we all know is just two short puts. So it looks like that's what they did. And they just sold the bejesus out of them, really kind of hit every bid there was. So I find it very, aggressive given the market that we've had recently. Somebody said, you know what? We ain't going up. We ain't going down. We ain't going anywhere. Sold. So that's what that looked like to me.
A little bit aggressive on the downside there. Like we said, if this trend continues, they could be flirting with that 13 handle out here in not too long. But our friend here is saying, nope, I'm confident I'm not blowing through that 13 handle, at least not by OC expiration. And I'm willing to put my money where the mouth is to the tune of over 7,000 of these Strangles going up for prices around 35 cents. Pretty aggressive. Not too worried about the 18 call, I don't think. But the put may perhaps, we'll see, may perhaps come back to bite him. Let us know what you think on this one, listeners. Would you sell that put as part of that Strangle? Would you adjust it a little bit? Or do you like that and wish, darn, I wish I had gotten in ahead of this 7,000 plus contracts? Because kind of a little bit late now. A wee bit of size has beaten you to the punch. And since we do like our themes, our thematic odd blocks, let's move on to a separate but related name here. This is Boardwalk Pipeline Partners. Take a guess as what these guys do. Ticker symbol BWP, closing right around the same range, actually, $14.08, up about a quarter today. So nearly 2% rally out here in good old BWP. And it's a name that does a whopping about 300 or so contracts a day today, doing a little bit more than that today in particular. A similar theme, just not both legs. This our friend coming in out here this time on the upside calls, pretty close upside actually. The D's 15s blasting out 9,240 of them in one mega chunk over there on the MIAX for 42 cents. Went up as price variation, but didn't see really any stock going up accompanying that, so it doesn't seem like the old calls and stock trade we're used to. It's really just appears to be on the surface anyway, just blasting off the trade. Looks like some additional ones went up at about 45 cents, but it seems like it could be an aggressive buy right, and again probably. Given the nature of it, the time frame, the relatively aggressive nature of it, probably against an existing stock position. Our friend out here saying, stock's not really doing that much. I'll take some 42 cents off the table, and I'll do that now, please. And I'll do it for some size, for a nearly 10,000 contracts. So Mr. Rock Lobster, again, somewhat thematic, aggressive premium selling, this time in BWP. What's your take on our friend here versus our Strangle seller friend before?
Yeah, I think there's definitely somebody, because some of these calls traded 42 cents, and I believe on the close they went out 45 bid, which is a little annoying when you sell.
Always a nice feeling when you sell 10,000 for 42.
Yeah, exactly. 45 bid, and the 45 bid was pretty firm. They scooped up a lot of extra options, so just in this particular one, it feels like normally that kind of paper is a buy rider, a pension fund looking for yield. They already are picking up 8-9% on the underlying from a divvy for the divvy stream, and they're just looking for extra money on the calls with the vol so high. But this is one of those things where it smells funny to me. It won't surprise me if there's going to be a little bit of a movement in this one. Somebody just wants those calls too much. It doesn't make any sense. So why do you want them, really?
You don't often see, an aggressive bid coming out on the heels of a name that does a few hundred contracts a day. Someone blasts out 10,000. I don't care where they're doing it, what strike, what month. You're going to see that reflected in the skew out there, and this is actually bid out. So yeah, not the typical movement we see out there. You're right. Perhaps that does signal that more is on the way. Perhaps maybe even someone thinks there's some aggressive upside to be had in this name. Either way, we'll pay attention to that one as we move on to our final name, getting away from petroleum, but into another area we like, which is technology, and to a strategy we're liking today, which is selling strangles. In particular, our last victim here is FMC Technologies, and of course, one of my favorites. I know that's why the Rock Lobster throws these at me, because the ticker symbol is, of course, not FMC, but FTI, because why wouldn't it be? And closing today, $33.18, down about a dime or so. So pretty much unched on the day from an underlying perspective, but rocking and rolling from an options perspective. It's a name that does about 700 some odd contracts a day. Doing a wee bit more than that. Again, blasting out some strangles nearly 9,000 times. This time, the OC 3036. So once again, keeping it close to home, too. Not longer-term strangles. These guys are all blasting things out in front month or pretty darn close to it. The 36 calls, actually backwards. The 30 puts going up for 30 cents. The 36 calls going up for 40 cents, net 70 cents. On that strangle, doing it, like I said, nearly 9,000 times. That initial 9,000 contracts going up in 2 blocks over there on the old ARCA. Again, hitting the bid to just blast out a lot of premium out here. Again, once again, betting pretty much not going anywhere anytime soon and doing it in a pretty tight range. Looking back over the last 6 months or so, and FTI, kind of like others, has been on a bit of a downward trend, was trading nearly $40 back in midsummer or July. Now, like I said, trading on the downside of the 30 handles there. And our friend betting, that's pretty much where it's going to stay for the at least next month or so. Mr. Rock Lobster, take us home with this final name in our thematic Strangle premium selling odd block here today.
Well, one thing, this is a oil technology services company. So I thought it was in the theme of oil as well.
So even closer to our theme.
I figure. I think that energy report came out and somebody just said, you know what, all this stuff is done. I'm selling whatever juice is left. Bang. And this is just one more underlying that they're doing it to. So it sounds like a fund, maybe an energy-based fund. They're scooping up all the shares, and they're going to help pay for that by dumping all this stock, by dumping all these options. I didn't see the stock print, but somehow deep in my soul, I feel like they own some somewhere.
Does kind of have a bit of that feeling to it. When you see random strangles in the near term like that, could be open, could be net on their own naked, but chances are there's something else, probably some underlying lurking there. In there, they read that study from the OIC on covered strangles, and they decided they needed to get in on that action.
Exactly, sell, and I think, but I don't think it's a bad play. I mean, where's the upside? Where's the instantaneous upside? I think if anything that's happened, a lot of that fast upside bounce is kind of, I'm sorry, we've gone piffly poo on it,
Another technical term, piffly poo. Well, he's another one playing a little bit of fire here because it was trading south of that 30 handle not too long ago, less than a month ago, August 25th. They hit about 28.73 or so. And it flirted around there for a little while before gapping back up above 30. So there is a chance those puts could come into action again. If he's a stockholder, then he's decided he doesn't mind buying some more down at those levels. Either way, an interesting one to watch. Let us know, listeners, what you think of these crazy premium selling strangles out there in the petroleum land as we move on into our next segment. I know it's Monday. I know you guys are expecting some strategery, but you just got a dose of it on Thursday. And plus, like I said, today's show is a little bit truncated. So don't worry, Uncle Mike will be back for more strategery on Thursday. In the meantime, it's time for you guys to rotate in some of your questions and time for the mail block.
Listener mail. Listeners write in.
Mail's in.
Mailbox.
All right, everybody. Welcome to the mail block. Like the man said, this is the portion of the show where you guys get to join us here. Send in your emails, questions at theoptionsinsider.com, your tweets, twitter.com/options, your Facebook messages, facebook.com/theoptionsinsider. Send us whatever the heck you want on StockTwits, stocktwits.com/optionsinsider. Just find us on the website and post a comment or use the website feedback form. Again, no shortage of ways for you guys to make your voices heard on the program. A lot of that is baked into the mobile app as well. So make it even easier for you guys to sound off. Just like our first question here. This comes from, I don't have the name here, so unfortunately you don't get you don't get your pride of place on the show, but your question will be answered. He says, regarding expiration, how many days before expiration should I pay attention to the open interest on strikes in order to highlight potential pin risk? Well, interesting timing. Of course, we are right around the old expiration. Just missed it, actually. But from an options perspective, this is an interesting one. We touched on this before in various capacities on the show, kind of this, a lot of this overarching mythology that is built up around the options market, that it can really move a lot of things with a great degree of momentum around expiration Friday, and this myth that all underlyings are going to pin all the time. That said, there is some gamma effect to be had around expiration. Strikes with large OI, if there is a lot of long gamma hedging going on, could keep things relatively pinned to a strike right around there. We certainly have seen some of that, and if there's a lot of open interest and not much near it, and the stock's kind of hovering near the strike, it could have a little bit of a gravitational effect on that. But as we said many times on the show, I think a lot of that is overdone. Options are not some sort of grand market moving device like they're portrayed in a lot of these things. And as we said many times on this program, if you're trading, if you're worried about pin risk, and listeners, if you don't know what pin risk is, we touched on it before, hit on our archive, search for pin risk on the Options Insider. I think we did a whole episode of Options Bootcamp, a different program, plug, where we talked about pin risk as well. But essentially, you're worried about risk on your short legs or on your naked short positions. And if that's the case, we've taught you many times on this program how to avoid that, is to close those things out right before you get to expiration. Then you don't need to worry about being pinned. It's not a risk anymore because you've taken it off the table. If you want to use it to speculate on underlying movement to perhaps maybe put on something else, that's a different idea. You're trying to spec on some sort of underlying movement as a result of options or the strike pinning. But if you're talking about pin risk, that's the easiest way to not worry about that. Forget about looking at strikes, forget about looking at open interest. Just close out your short positions going into expiration a day or two ahead of time, certainly by the morning of expiration, and you don't need to worry about it. It's not a factor. Pigs get fed, hogs get slaughtered. We said it many times here on the show. Close out your shorts. If you're worried about pin risk, just close them out, and you don't have to worry about it. Uncle Mike, I haven't heard from you in a while, so we'll start with you. What's your take on our friend here who's extremely concerned about pin risk around expiration?
Well, I think it's like what you just said, Mark, in terms of if you get out of it before it's an issue, then it's not a non-issue. I always refer to this as the best counter to a double chicken wing if you're a wrestler is just not to get into it in the first place. And so in terms of pin risk, I try to be out of the positions before it's even an issue to begin with. In terms of whether it will be an issue or not, you can look at it a couple days before, you can look at it one day before, maybe 2 days before. You can make an argument in a lot of different ways for it, but quite honestly, I think this is one that for retail traders, unless you're trying to create some type of mass institutional penny or two gain at the retail trading level, I don't think it should be an issue to begin with.
I tend to concur. Mr. Rock Lobster, what's your take on this, sir, and all this concern over pin risk?
It's just any other. There is a tendency for stocks to go to the strike with big open interest because of market maker gamma. It does happen, but it's still, it's still a crapshoot. If you're worried about it, or if you want to sell options and you're looking for the pin, that might be, I'd say, a week before. But 3 weeks before anything like that, you might as well forget it. It's mostly just as you're going into expiration. I think it's kind of overused as a great tell-all, but it is somewhat useful sometimes, but I don't think it's meaningful enough to actually, trade it on a because now you have expiration every week on a weekly basis.
Yeah, it's kind of like what we were saying before, the change of the landscape to more frequent expirations has really reduced a lot of the impact of a lot of the things that used to be such big deals. We had quadruple witching last week. Did anybody really give a crap? It's not the deal it used to be. Triple, quadruple witching. Expiration, no longer the thing it used to be, because expiration is now every week, and in the near future, probably sometime in the next couple of years, it might even be daily. If you're trading some binaries now, it already is daily. So, the notion of expiration, notion of these great kind of binary type events where you're going to have, you're above the strike, you're below the strike, and all the gamma and inherent issues that go along with it are starting to evolve and become lesser because they're more frequent. And so, all these things that used to be these big issues like pin risk, and Andrew's right, things still sometimes pin. So maybe you want to try to spec on the underlying, get a few cents here or there on something going to a strike with a lot of open interest. That's something. There's an idea there, but it is kind of overdone. If you're trying to build a model around pinning, you're doing a lot of work and a lot of effort to maybe capture a few cents. You're not seeing 3-handle gaps in an underlying usually, just because there's a lot of OI on the strike. That can happen in some of these bigger, higher flying names, but you're spending a lot of time and effort to chase something that's going to probably return very little for you. And if you're worried about risk, again, close off the shorts. You're good to go. All right, that's going to do it for the mail block on this truncated episode. And now we're going to keep on rolling into our final segment. It's time for Around the Block.
Around the Block.
All right, everybody, welcome to Around the Block. You know the song and dance by now. This is the portion of the show where we tell you what we're watching, what we're keeping an eye on, and a lot of eyes are still Fed-bound. We really don't know what the heck those guys are up to over there, despite all the minutes coming out. There seems to be a clear diversity of opinion on the board. Clearly, they didn't raise, so that put the hawks perhaps into the minority there, and a lot of people just saying these hawks have very little ground to stand on anyway. Of course, there are other things at play in the marketplace right now that are perhaps continuing to allow some volatility to remain. As Andrew was just saying at the top of the show, the term structure is still showing perhaps there are some other shoes to drop out there from a volatility perspective. So it's anyone's guess as to what will be rocking and rolling us. Of course, we are approaching yet another earnings cycle, not really in the teeth of it yet, so that won't be doing it. So maybe we'll start with you, Uncle Mike Tucson. What are you watching? What are you waiting? What are you keeping an eye on for the rest of this week, sir?
Well, a couple things I'm watching right now, and from a news standpoint, there's really not a lot to watch at this stage. I think that as earnings come a little bit closer to fruition, then we'll have a little bit more to watch in the news front. But what I'm watching right now is what I've been watching for a while. I want to see if we can break through the 2,000 mark on the S&P again. For now, we're a little bit below it. I would still recommend staying cautious in this market. If you are a bull like me, like Andrew has said at times, put spreads can pay the bills. They're boring, but they can pay the bills. And just waiting for another dip to sell some put premium in some way, shape, or form. But for the time being, I'm really going to stay clear of things until we break the 2,000 mark on the S&P.
Playing the old wait and see game once again, sir. You diehard wait and see, are you?
That's pretty much what it seems lately.
All right. And that echo means we are joined yet again by the Rock Lobster, Mr. Rock Lobster. Before the internet gods decide we can no longer do a show here, what are you watching for the rest of this week, sir?
I'd like to see if just the fixed futures could get back into some kind of contango and stay there for a couple days.
Easy for you to say,
term
sir.
Structure is too nasty. It's just too nasty. So, and it hasn't. We've been in it for about a month, which is a pretty good long time. And the Fed didn't do us any favors. And as like Mike was saying, wait for a dip before you sell some put spreads. And as far as selling vol, I'm looking for a better signal on it. But right now, it's kind of I'm just going to say it's muted. I'm sure it'll be lower at some time in the future, but it doesn't feel like it's going to go lower anytime soon, even though we've had a couple of good, very short-term sell-offs in them, but nothing sustained.
Yeah, all these Strangle sellers aside, it does seem like perhaps a questionable time to be hitting bids left, right, and center out there, because you're right. Everything is pointing to the fact that there are perhaps other shoes left to drop out there. No one's really confident in any of these levels in the marketplace. And if you're blasting out to puts or calls or strangles, in the case of today's odd block or whatever the case may be, it is perhaps a bit of a risky road to hoe. Vol probably will be lower, but yeah, how we get there and what will happen between now and then, you're right. It's going to be a bit of a rocky road. I don't think anyone will have too much sleep if they're blasting out a lot of premium and just sell the preem, live the dream. That may be a rough trade at least for the next few weeks here while we sort all this nonsense out. All right, and speaking of sorting out nonsense, we're going to get to work on doing that, so hopefully all of our regular systems and hopefully Microsoft and Skype will play ball with us on Thursday, but we have some decent backups in place, as you guys can hear, so that hopefully won't infringe upon the show going forward. And before we go, as always, let me check back in with each of my cohorts here, my partners in crime who jumped through some impressive technological hoops just to be on the show with you today, listeners. So let's pay attention to what they have to offer you. Let's give them some love back. Starting out with you, Mr. Rock Lobster. What's coming down the pike in the land of the pit?
We have our boot camp. Boot camp. Starts September 30th, goes to October 3rd. Go to optionpit.com/events and sign up if you want to learn about all the stuff that Mr. Tucson, myself, Sebastian, and Longo talk about, risk management, understanding the Greeks, how to just look for trades that look interesting and take volatility into account so you don't get taken to the hoop. You'll learn a lot in our boot camp. And as usual, the only thing we guarantee is that you'll learn a lot, and most likely you will save yourself. Whatever the cost is, you will learn enough to save yourself on whatever your next trade is. That's our non-money back guarantee.
That should be your tagline, your 0% guarantee that you will save at least whatever it is, $120 by on your next trade. Or your next 10 webinars are free. How's that sound?
Something like that, yes.
There we go. Speaking of 0% guarantees, actually, no, he's more of the 48% guarantee. Uncle Mike, what is coming down the pike in the land of RCM?
Well, first off, I'm a full 50% guaranteer kind of guy.
Ooh,
so
upgrading,
just so you know,
getting a little more risky these days.
I've always been risky. You always confuse me with Kavanaugh. He's the one that plays roulette. But anyway, along those lines, if you are looking for a financial planner in one way, shape, or form, along with an investment advisor, trader, whatever the case may be, feel free to give me a call at any time. We are having openings now that the fall season is underway. Feel free to give me a call at 312-212-3531 or send me an email at mtosaw@rcmfs.com.
There you go, listeners. Hit them up over there. Again, show them some love because they went through a lot of hoops to be on the show just for you today. And on behalf of Uncle Mike and the Rock Lobster, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for following along on our technological adventures this episode. And we'll see you next time right here on the Option Block.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.